Price is gonna be set by the banks, so you have to think in fair value. The market moves from buy stops to sell stops to buy stops, fair value to discount, discount to premium, premium to fair value. Back and forth. That's how the market moves. So my journey to mastering fair valuation, when I first started trading in the forex market, I was constantly losing money. And I couldn't understand why. I couldn't grasp it. No matter how much research I did, how many strategies I tried, and you probably tried many strategies also, I just couldn't seem to make any profits. That was until I stumbled on the concept of fair value or fair valuation in the forex market. So I started to focus on valuing my trades based on real market conditions rather than relying on speculation and emotions. It took me time to practice, but eventually I was able to turn my forex trading around and become a profitable forex trader. If it wasn't because of me understanding fair valuation in the forex market using ICT concepts, smart money concepts, I may have given up on trading altogether a long time ago. You feel me? But now I can confidently say that it is the key to my success in the forex market. And understanding fair value of a currency in the forex market is crucial for trading success. This concept can help you make informed decisions. You don't just fall into trades anyhowly. You're going to avoid potential losses and achieve consistent profits. You feel me? So by the end of this video, you'll have a clear understanding of fair value in the forex market as it coincides with smart money concepts. You feel me? And how to apply it to your strategy, to your trading strategy. Say goodbye to all the haphazard trading strategies and whatever, and say hello to consistent profits in the forex market. You feel me? You feel me? So if you're ready to become a forex pro, just hit the subscription button and join the ranks of the forex elite. So welcome back to the channel. Obviously, we're talking about fair value today, but the first thing you need to understand about ICT concept is that to understand institutional order flow, there has to be movement. And by movement, I mean to be a buyer, there has to be bigger pockets, like the banks, the pro firms. It's a greed factor. It is a greed factor. Price alone will give you everything you will ever need. You feel me? Entries, exits, stops, and whatever. So the second thing is we used to use the Fibonacci level to illustrate equilibrium, and equilibrium is fair value, right? Equilibrium is fair value. So let's go. So we have a chart here, the GBP USD on a daily time frame. So the first question I'm going to ask is, what is fair value? Yeah, what is fair value? So let me illustrate what I mean by this. So this example here, we have this bearish order block, right? We have this bearish order block. We're in the buy side market. The direction of bias is to the upside, right? As the trend lines are showing you. So listen to this. So price rallied to the upside. After to rally to the upside, it rallied back inside here. So this is where the magic happens. So fair value is when price returns to the low of the bearish order block. That is, price returns to fair value. Look at this bearish order block here. Price rallied, it comes back actually to the high of the bullish order block. That becomes fair value. You feel me? If you're buying, you want to be buying lower. That is equilibrium and less. Remember, equilibrium is fair value. Yeah, equilibrium is fair market value or fair value market. You feel me? I have nothing to sell to you. I make these videos so that you can use this stuff, so that you can make a lot of money, and so that you can join the 1%. So my goal is always to give you a few lessons that I learned and take you a little closer to wherever you want to be. I want to take you a little closer to whatever goals you want to achieve this year, 2023. So I hope by these concepts that I'm sharing with you guys, I hope you take some value and really use it for your own self and become better in all aspects of your life. So let me show you by what I mean by that. So let me pull out the Fibonacci tool. Remember, Fibonacci has no magic. it helps you see what equilibrium is in price and where to enter at discount. You feel me? So if you get a Fibonacci level from the swing low to the swing high, swing low to the swing high here. Let me adjust that real quick. Swing low to the swing high, right? You observe that price came back to equilibrium, right? Price came back to equilibrium here. Then it dropped into the 61.8 level, halfway to the 70.5 level. That is OTE, optimum price entry. Then what happened here? I told you guys, price does not remain at equilibrium or less. That's a discount, right? It does not delay at discount for a long time. It just rallies away. So as I'm still talking about fair value and whatever, I have to tell you something. Forex trade is just not about making money. It's about having financial freedom. It's about having the ability to work from anywhere in the world, to have freedom to travel, to live a life on your own terms. That's why Forex trading is the perfect solution for anyone looking to take control of their financial life. So the key to Forex trading is having just a solid strategy, discipline, patience, and whatever I've showed you today, I'm showing you this fair valuation tactics and tips. Just make sure you apply this. And if you learn how to manage your risk with this strategy that I've given you, your confidence will just skyrocket and you'll make a lot of profits. So back to what I was saying. So again, equilibrium is fair value, fair market value. It's neutral. Yeah, it's neutral to bullish condition. You're not paying anything. Price does not spend too much time below equilibrium. If you're in a bullish market, just like we are here, we look for impulsive market swings on the daily time frame. Then we look for that reversal to happen. You don't have to spend too much time on the daily time frame, of course. But the best buys come at equilibrium or less. The market rallies the moment it's below equilibrium. That's discount. You feel me? Yeah. This is not based on Fibonacci. The banks will not buy until equilibrium or below. You feel me? The algorithm will kick in at buy mode at equilibrium or below. So one more thing is you see this order block, this daily order block here. So the way you determine fair value is, let me first remove the Fibonacci. The Fibonacci is, see this order block here, this bearish order block. So the gap between the top of this order block here and the next bearish candle is what we call fair value, right? That gap here, and price wall is back to filling that fair value. So this is a fair value gap. You feel me? When the market returns back to an area of fair value, that is fair value for the market makers to either sell or buy. For this case, we are buying, right? It's fair value for them to liquidate, to get liquidity at fair value. You feel me? The market moves from buy stops to sell stops to buy stops, fair value to discount to premium to fair value, back and forth, So you have to think in terms of fair value, right? Because price is gonna be set by the banks. So you see this liquidity void here was created. And what are liquidity voids? The liquidity voids are, how do you identify liquidity voids? These are quick runaways, right? Sudden movements from the market. This here, we have this here, we have this here. Like price moves in larger ranges. Very little wicks, it has very short wicks, you see. No wick down here, a short wick up here. Short wick, no wick up there. Yeah, very quick sudden movements. Price is in a hurry. That's a liquidity void. So you want to take note of liquidity voids, order blocks, impulsive moves from the order blocks. You feel me? And quote this: the importance of fair value in the forex market, smart money concepts. I've always heard about the importance of fair value in forex market, and I never really took it seriously. So don't be like me. I thought I could make quick profits through speculations and luck. just bobbing a 218 trade and doing whatever I thought was right. But boy, I was wrong. I lost a significant amount of money in a short amount of time, and I knew I needed to make a change. I decided to focus on trading the right way. That's using fair value in the market, using the Fibonacci, liquidity voice, and whatever. It was a difficult process, and I had to let go of my ego. And I had to admit that I didn't know anything. I had to start from scratch. I had to learn how to value my trades based on real market conditions and not just what I hoped would be. You feel me? It was a hard lesson, but it taught me the importance of being humble and realistic in forex trading. Now I can say that with this concept of ICT concepts, smart money concepts, fair valuation in the markets, fair value gaps, whatever I'm teaching you guys in this video here is the backbone of my trading strategy. And it has helped me to become more successful in the forex market. And once again, I always tell you guys, I have nothing to sell to you. All this information is free. Why would you buy a forex course yet you have all this information here at your fingertips? That's why I can't sell you anything. So let's go back into the video. So I've brought back my Fibonacci tool here. So if you take a close look at this price, after this order block was formed, it had an impulsive price move. Then we had we had this candle here making the high, the middle candle, then the reverse was formed as a pullback or retracement into equilibrium or less. But price didn't spend too much time there. It rallied away, forming another impulsive price move, hence forming a higher high. So as soon as price comes down to equilibrium, we drop to lower time frames and hunt for buying opportunities. This is context. This is not buying signals. You feel me? So we don't do anything when price is up here. Wait for it to come back to equilibrium, to 50% fair value. Then it drops from the daily time frame to the 4-hour time frame, as I'm going to show you here a little bit. You know, so I want to explain this. Buys back at equilibrium. So for example, it's a daily example. If you go to the groceries and buy stuff, of course, all of you guys have gone to the groceries. I hope so. If you're human, of course. If you've ever bought meat or steak, if steak costs $10, then it drops to $8. That is discount, right? It's a discount price. $8 is a discount price. And if you've ever bought anything, whether it's a smartphone or whatever it is, you know, prices do not stay at discount for a very long time. That's the point I want you guys to take from this. Price does not stay below discount for a very long time. That's why you have these Fibonacci levels here. You feel me? So after this market rallied here, it continued to rally to the upside. Then see what happened here. This market came back to filling the liquidity, no, the fair value gap. Remember I told you guys, from this bearish candle here to the next bearish candle on top, that's a liquidity, no, that's a fair value gap. And this candle did quite fill it in to the T. Look at where I stopped. It didn't fill it in. So these other candles here came and fill it in after how many days? These are weeks. These are weeks. This was November 30th, 2022. And it got filled in on 5th January 2023. And what? To finish it off was 6th January 2023. So history that repeats itself, you know. So you just have to have these concepts in mind. So let's drop down to the 4-hour time frame and I'll show you guys what I mean by this. So the 4-hour time frame, let's look for it. So after identifying this on the daily time frame, we drop down here. When you drop down here, look at what happened here. Swing low, swing high, no problem. Price comes back to equilibrium for the first time. But this is our order block for the daily time frame. This range that we have here in the shaded area. So for us to take the optimal trade entries, we can still buy at equilibrium, but that's not where the optimum trade entries are. Optimum trade entries, as the name says, is at 70.5 or 61.8 levels, or at best OTE. So the novice traders, the new traders would have taken these trades at equilibrium, which is not wrong. But if you want to have a high success rate, you want to be taking these trades at below equilibrium, as I've told you guys. So the first one comes in. Look at this. We don't touch our liquidity zone, or we don't touch our order block zone. The first attempt. Second attempt comes in, still the same thing. Then we have this turtle soup here. Turtle soup, like that's like a manipulation, taking out equal lows here. As you can see, it's quite visible. We have this first low and a second one, so you took it out. So what do you know about turtle soups? The moment a turtle soup happens, you just know price is going the opposite way. Whenever someone is being manipulated in the market, just know the price is going the opposite way. And what happened? What happened there? You see what happened? Price made a turtle soup, taking out these lows here. Look at what the next candle did. The next candle tapped into the 61.8 level, into the 70.5. That's optimum price entry. This is so simple. This is so simple, guys. Optimum price entry. Yeah, but so if you made it this far, clap for yourselves. Yeah, thanks for watching. Don't forget to like, share this video with your fellow traders, and I'll see you at the top. Hit the subscription button and join the ranks of the Forex elite. I will see you in the next video.